But let's talk about what's happening with the AMCs. Equity mutual fund inflows hit a one-year high in the month of March. The SIP inflows also remained rock steady and reached a one-year high of about 20,000 crore rupees. To discuss this and more, we are joined by Radhika Gupta, the Managing Director and Chief Executive Officer at Edelweiss Asset Management. Nilesh Shah, the Managing Director at Kotak Mahindra Asset Management, is joining in as well. And of course, we will be talking about a lot of the developments that have happened on the regulatory side and whether that will, impact the AUMs going forward. There were a lot of changes that were announced in the budget too. Lady and gentlemen, thanks a lot for joining in. Radhika, first, I want you to come in on this. There were a lot of regulatory changes that have taken place in the budget, and the fear is that this will hit the total expense ratio, and eventually the AUM growth, the yields as well could suffer. Tell us a little bit about your version of how this could play out for the industry.
So, Sonia, if you are referring to the conversation that SEBI put out on the review of total expense ratio, then I think, while that conversation is yet to conclude and we're yet to see the outcome, I think over the last 10 years, the mutual fund industry has seen a lot of regulatory changes. Recall there was a TER cut in 2018. We've had a change in upfront commissions. A lot of things have happened. And while margins may have come under pressure as asset management companies, I think volume growth has compensated. So finally, net, asset management companies, the numbers speak for themselves. It's a 40 lakh crore industry. So I truly believe that while margins can come under pressure, volume growth will compensate for it. And we still are in a country where under-penetration levels are so prevalent that the growth room for AMCs is substantial. The second change, I think perhaps that you're alluding to, of course, is the whole change around fixed income taxation. And as far as that is concerned, I think it is wait and watch for the next 3 months. I know a lot of people have been saying, oh, FDs are now far more attractive. Yes, certainly debt mutual funds are, the tax alpha or so, is gone. But I don't think the story is so simple. I mean, we are the largest player in the target maturity fund fixed income market. And I still think there's a lot that the open-ended debt mutual fund has to offer that traditional instruments don't have by way of liquidity, structure, longer term options. I mean, you don't have 10-year FDs in the market. So I think it's wait and watch. Consumers, yeah.
Radhika, just on follow-up, you said margins could come under pressure. I mean, because of what's happening with the regulatory changes, right? I mean, the total expense ratio now will include GST, brokerage, STT. There's a uniform total expense ratio across schemes. So can you quantify for us what would the margin pressure be? Because there was a brokerage report, BOFA actually downgraded a lot of the AMCs, saying that there's significant amount of pressure expected. Could you quantify it for us?
I think it's too early to speak to that because all this is conversation until something concrete on TER comes out. For instance, if brokerage and GST were to be included, and I'm saying this is just a conversation, perhaps total expense ratio might be increased just a little bit to make up for that. So I think everybody is cautious of the fact that there are listed AMCs, who have meaningful market cap and, any action will be thought through. So I think it is a little early to quantify exactly what the impact on margin pressure will be because the rules are not out and I know a lot of discussions are happening.
Radhika and Nilesh, great to have both of you here. Thanks very much. Nilesh, if I can come to you on this total expense ratio and not from your firm's point of view, but from an industry point of view, if you just step back, because this will have implications, right? If brokerage, etc., is included within the total expense ratio, I'm sure AMCs will pass some of this on to to the sell side in terms of lower brokerage paid. That has then cascading effect in terms of the quality of research, service, the coverage of stocks. Just talk us through. I mean, the implications of if something like this were to actually happen. Because as Radhika said, while it has not happened, what we heard from the SEBI chief, it seemed like they were very keen that this should be the path going forward. Your sense, Nilesh?
SEBI's processes of consultation, as industry, we have shared our feedback. We hope and pray that the feedback will be considered while formulating a policy. At the end of the day, we will have to follow what the regulation is as business, we will definitely try to optimize our cost, share our burden with partners. But at the end of the day, do remember that there are three models in industry. One model is new pension scheme, where dice is loaded in favor of investors with very, very low operating expenses. And the manufacturer or the distributor does not get rewarded for their efforts. Despite giving tax incentives, the total AUM in NPS is less than 60,000 crore from non-committed subscribers like government employees. The other side of the model is insurance, where dice is loaded in favor of distributor and manufacturer, and investors have to bear higher cost. We believe mutual fund is the right model, where dice is equally in favor of distributor, manufacturer, and investor. We believe in SEBI as our regulator will do everything to expand mutual fund industry and support its growth so that we can continue to provide financial freedom to every Indian.
But that's very well explained, Nilesh. Could you tell us, Nilesh, I mean, so on an average, what is the brokerage that you pay at this right now?
So the brokerage which is paid to sell side is regulated under SEBI regulation. There is a cap of about 10 to 12 basis point on a cash trade. And on the derivatives trade, it's even lower. So effectively, the domestic brokerage or sell-side brokerage receive a very, very restricted amount.
Correct. So if this 10-12 paise is included into the TER, I mean, could you tell us what could be the implications for profitability? Or this, as you said, you began by saying some of it will be split in terms of you'll pass some of this on in terms of lower commissions, etc. But broadly, what kind of numbers are we looking at, Nilesh? Is there a way to assess at this point?
Prashant, we will cross the bridge when it comes. As of today, we really haven't done calculation in terms of what will be the brokerage outflows, what will be impact on TER, because this is part of a fairly broad reform package. This is just one element of what's probably expected to come. So once it comes, we'll have to look at it and do a fair division. There will be benefits for investors undoubtedly. There will be cost sharing between manufacturer, distributor, and also sell-side brokerages. But my limited request is, please remember, if we go towards NPS side, where everything is loaded in favor of investors, there will be sacrifice of growth. And again, I repeat, only 60,000 crore AUM is there in NPS from non-committed investors, despite giving handsome tax benefits. You get about 3% tax savings if you subscribe to NPS from your employer's side. This is the highest tax incentives ever offered in India, and yet you have only 60,000 crore after more than 1.5 decades. On the other side, we know when the dice is loaded in favor of manufacturer and distributor, the investors' interests are shortchanged. Mutual fund industry is balanced between cost and benefit. It is shared equally the pie between manufacturer, distributor, and investor.
Sure. Got it. All right, just one final question, Radhika, to you. You were talking about the debt funds, right? With this recent withdrawal of indexation benefits, how do you see the flows into debt funds get impacted over the next, say, year or so?
So I break this into two parts. One is under 3 years, where anyway there was no impact of taxation. So I think there your liquid overnight short-term funds, will continue to be business as usual. I think a category of funds called arbitrage funds, which was popular with corporate and HNI investors, it's fixed income like in structure, but still has equity taxation, will continue to be more popular. In fact, perhaps more popular than it has been in the past. Over the 3-year category, where the tax benefit is, has some impact, I genuinely think it is wait and watch. As you know, AMCs, of course, got large flows in March before the tax change happened. And I think customers have parked a large part of their asset allocation, at least for the last couple of months, through the months of March. Now it is wait and watch. And I repeat, I don't think that, the answer is so black and white. For instance, in an FD, you don't have longer term options. You have to pay tax every year. In a mutual fund, finally, you pay the tax on redemption. So there are still a lot of benefits to mutual funds. And I think liquidity is a huge benefit. I think consumers will choose the option. I also think one category of funds that will get more popular is hybrid funds. Rather than doing equity and debt standalone, you can do it in the context of a hybrid fund, like a balanced fund or a balanced advantage fund, and enjoy equity tax benefits. So I think hybrid funds will become a more popular way for the retail customer to do asset allocation, and that's something the industry has very strongly advocated.
All right. Thanks so much, Radhika, as well as Nilesh, for stopping by and discussing this topic. We look forward to further clarity, and we'll have a chat in the coming months as well. Well, let's move on then.